Today we will start with chapter 3, Introduction to Accounting. After you completing this chapter, you can explain the differences between the financial accounting and management accounting, and then you can describe the organizational data related to financial accounting. You can also discuss and analyze the key types of master data involved with financial accounting and explain and apply the basic accounting concepts and execute key processes in financial accounting. And we can identify the key integration points between the financial accounting to other processes, and also can prepare some reports on financial accounting. And as we know, in the chapter 1, we already introduced some processes that most organizations use in their daily operation. So like such as fulfillment, production, procurement, and the financial accounting has a very critical role, and it is to record the financial consequences of the various process steps. And the organization uses this financial information to plan and manage those processes. Accounting processes are broadly divided into two main categories. The first one is financial accounting, or we call FI. And the second one is management accounting. For financial accounting is concerned with the recording the financial impacts of the business processes as they are executed. And the business process use these data to generate financial statements to meet the legal or regulatory reporting requirements. For instance, in the US, the SEC, or Securities Exchange Commission, they require that all of the publicly traded companies have to submit the financial statements in a specific format. So, in the certain regulated industries, such as energy and healthcare, have additional reporting requirements imposed by their respective regulating agencies. These reports are externally focused. This means that they are intended mostly for the audiences outside the organization. However, they are also useful for internal management purposes. About the management accounting or controlling, CEO is internally focused. It means that it provides the information the organization needs to effectively manage the various processes. And management accounting processes like financial accounting or FI processes, they use the financial data recorded during the process execution to generate reports. Specifically, the CEO reports focus on the costs and revenues which management uses to achieve the basic business objectives, such as increasing revenues or minimizing the costs, achieving the profitability. However, financial accounting, the content of these reports is not prescribed as financial accounting, but for the CEO, reports are based entirely on management needs. So we can see in this table, we will highlight the key differences between the FI reports and the CO reports. And we can see that the difference between the focus or purposes or content are different. From the ERP perspective, financial accounting is the heart of the system because it must reflect the financial status accurately of the firm at any given point in time, as you learn about the processes in the later chapters. So for this reason, we will focus in financial accounting is closely with the management accounting, and consequently, we introduced a few basic management accounting concepts as well. So these are the processes in financial accounting. The first one is general ledgers accounting, and the second one accounts receivable accounting, and accounts payable accounting, and the bank ledger accounting. The general ledger or GL is used to record the financial impact of the business's process steps, and it contains most of the data needed for financial reporting. For the accounts receivable accounting is associated with the fulfillment process and is used to manage money owed by the customers for goods and services sold to them. So we call that the account receivable accounting. And the next one is accounts payable accounting. Is associated with the procurement process or buying process. The companies use accounts payable accounting to record and manage money owed to the vendors for the purchase of materials and services. And next one is assets accounting. Is used to record the data related to purchase, use, and disposal of assets such as buildings, equipment, machinery, etc. And the final one is the bank ledger accounting. Is concerned with the recording data associated with the bank transactions. And so the financial data recorded in the general ledger are used to generate the financial statements needed for external reporting. Typically, financial statements are the balance sheet, income statement, and the statement of cash flow. So those are the related to the financial terms. A balance sheet is a snapshot of the organization at a point in time. So it identifies assets, liability, and equity. And the next one is the income statement, or also known as profit and loss statement. It indicates the changes in the company's financial position over the period of time. So it identifies the revenues, the costs, and profits, or even losses. And the final one is the statement of cash flow. Displays all of the cash receipts and payments over the specific period of time. For the client is the highest organizational level in the system. The client represents an enterprise that consists of multiple companies. So even the largest enterprise can have only one single client, and various companies within the enterprise are represented by a company codes, by a company code. So applying this scenario to the GBI, the global GBI enterprises are represented by a client, while the two companies, GBI in US and GBI Germany, are represented by company codes. They are USOO and DEOO respectively. So the financial statements are generally prepared at the company code level. So the GBI US and the GBI Germany will generate separate financial statements to meet their regulatory requirements in each country. About business areas, they are the internal divisions of an enterprise that are used to define areas of responsibility or to meet the external reporting requirements of an enterprise segment. So what is a segment? A segment is a division of an enterprise for which management monitors performance such as revenue, the costs, the profitability separately from other segments. Financial statements are generated for each business area within the enterprise. So a business area is often based on the enterprise product line or its geographic division across company codes. So in this table, Alice shows two business area for the GBI. So the upper part of the figures identify the three companies within the GBI enterprise. We have the GBI US, the GBI Germany, GBI Australia. So it also defines two business areas based on the product lines, bicycles, and accessories. The GBI will generate the financial statements for both business area across all three companies. In contrast, in the lower part over here, the business areas are defined in terms of geographical locations of individual companies. So the financial statements are generated for all companies in the North America or in Europe. Well, we know that the goal of financial accounting is to record the financial impact of business activities. So in the master data, these data are recorded in the company's general ledgers. More specifically, the general ledgers includes many accounts that the company used to record financial data. Each account tracks different types of financial data, records sales, revenues, and other accounts records the costs associated with producing and selling products. So a list of accounts that can be included in general ledger is called a chart of accounts. And in the next part, we will investigate about the chart of accounts and the general ledger accounts. About the chart of accounts, or we call it the COA. It is an order listing of accounts that comprise company's general ledger. So there are three types of charts of accounts. The first one is the operative or operational COA that contains the operational accounts that are used to record the financial impact of an organization's day-to-day transactions. So it is the primary COA maintained in the organization. And the next one we call is the alternatives account in the country's specific charts of account. The companies create these alternative accounts to meet special country-specific reporting requirements. And we can see in the this figure over here shows a scenario in both the GBI US and the GBI Germany use the INT COA chart of account. Why? Each company also maintain its country-specific chart of account in Canada or in Germany, COA. And finally, we have the group of account contains a group accounts that multiple companies within an enterprise use to consolidate their financial reporting. Why? And when an enterprise includes several companies, then it can create the financial statement for each company by the company code. So it must also create financial statements for the enterprise as well. So this consolidation is necessary. Why? Because the enterprise is itself a separate legal entity. For example, it's a holding company, and it has reporting requirements itself. So using a group chart of accounts will make it easy to generate the consolidated financial statements. Otherwise, the enterprise must rely on more complex methods of consolidation. All enterprises must maintain operative chart of account or COA in order to record the financial data. In contrast, group or country-specific chart of accounts are optional. Accounts in the general ledger are defined based on the selected COA. The general ledger is an instantiation of a COA for particular company and can include some or all of the accounts in the COA, like most master data in the data. The data in general ledger accounts are segmented by organizational level. In this photo, show that the COA accounts include the COA or the client segment and the company code segment. COA segment typically includes an account number, long text, short text, and account group, and an indication as to whether the account is a balance sheet or a profit loss account. Each account is assigned in a unique account number to distinguish it from other accounts in the COA. And each account also includes a long text, or we call it the description, or the short text or brief description of the account. And the account is either a balance sheet or profit or loss account has implication for the ways the balances in the accounts are treated at the end of the year. For example, the balances in balance sheet accounts are carried forward into the same account. So the balances in the profit and loss accounts are carried forward into different and specified accounts. You can see over here, we have the balances account, and we have the asset and liability and equity. So the assets, this is a very important question. Assets is equal to liabilities plus equities. So those are the sample assets. We have the current assets or the fixed assets, for example, the land and the building, and the current assets, the cash in the bank, receivables, inventory, and prepared expenses. Liability, we have the short-term liability like payable, and the long-term liabilities like the loans, and equity is shareholders equity or return earning. And the next one is also a very important question, is for the income, and is equal to the revenue minus expenses. Revenues like the sales, and expenses, for example, like the payroll or the taxes, etc. Let's take a look at the assets in more detail. That's what assets is defined like what the company owns. Liability is defined like what the company owes to others. So including the money owed to the vendors, we call that payables, or the loans from financial institutions, banks. And the owner's equities refers to the owner's share of the company's assets. So the revenues are the monies the company earns by selling its products and services. Expenses are the costs associated with creating and selling those products and services. Photo show the general ledger account example. So in this photo shows the two segments of the GBI bank account. The chart of accounts segment indicates that the bank account number 100,000 is a part of the GL chart of account COA. And both GBI in US or GBI in German use this account, but the two companies use it differently, specified in their company cost segment. For example, two companies have different company costs. In the US, they use the US 00, and in Germany, they have the DE 00, and they use different currencies. And the next concept is about the soft ledger and recon accounts. Some financial data are not directly maintained in the general ledger. For example, customer accounts will track the amounts of customers owed and the payments they have made are maintained separately for each customer, although it is necessary to track sales and payments separately from each customer. It is not necessary to include each customer account into the general ledger. Similarly, the data about each vendor and asset, such as automobile, are maintained in separate accounts, and the vendor accounts track purchases from and payments made to them. Asset accounts are used to track the purchase price as well as and decreases in the asset's value over time. So such accounts are maintained in subsidiary ledgers, or we call subledgers in short, and they are not part of a general ledger. Although the customer and the vendor's accounts are not a part of the general ledger, the data in each account must be reflected in general ledger. The companies accomplish this task by posting the data from subledger accounts into the special accounts in the general ledger account called reconciliation accounts or recon accounts. The reconciliation accounts are the general ledger accounts that consolidate the data from a group or related sub-ledger accounts, such as customer and vendors. The reconciliation accounts for the customer is account receivable, and the reconciliation account for vendors is account payable.